With inflation in Europe on the way back down and after a rate cut in June, the ECB just announced that it will keep rates stable for now and that anything can happen in September. So does this mean that higher interest rates are here to stay? Or could we soon return to the ultra-low inflation and interest rates that we were used to before the pandemic? To find out, I sat down with the ECB's chief economist, Philip Lane, for a long conversation about how the ECB looks back at the past inflation spike, its own response by raising interest rates, whether or not higher interest rates today are causing too much collateral damage, for example by holding back investments in new energy sources or new houses, and finally about what we can expect from inflation and interest rates for the future. So Philip, thank you so much for talking to us all about interest rates and inflation in the Eurozone, a topic that has perhaps been on the mind a little bit too much in the last couple of years. The goal of this conversation is really to talk about what we can expect to happen next with interest rates and inflation, with the context being that the ECB just announced that they will keep rates steady for the moment. But to get here, I just figured maybe you can explain to us all a little bit sort of what happened, starting with if we go all the way back to the pandemic, where we have seen inflation spike in an unprecedented way for at least a younger audience. Like this was unprecedented. Like, what were some of the lessons learned there? Or maybe actually we can start with looking back. What was behind that inflation spike?
So thank you for the invitation. It's a pleasure to have this opportunity. So maybe I'll start 5 years ago in summer 2019 when I joined the ECB. So when I joined the ECB, we were in the middle of a long period where inflation was around 1%. Our inflation target is 2%, and in response to that low inflation situation, we had adopted policies that were accommodative. In fact, in September 2019, we moved the policy rate from minus 0.4 to minus 0.5. So that may sound strange to some of your viewers, but we had negative interest rates.
Trying to encourage inflation.
Right,
actually,
and on top of that, because there's a limit to how negative you can go, we were also engaged in a big bond purchase program, which we restarted in September 2019. So before the pandemic, a few months before the pandemic, all the view was this is going to be with us for a long time, a low inflation problem. Mm-hmm. Then in the first year of the pandemic in 2020, in fact, inflation fell. It went a little bit negative in late 2020. So in 2020, initially the focus in the pandemic was with the really big drop in activity, the drop in spending, that in fact there was a drop in inflation. Okay, what happened next?
And is there then the sort of the simple economic model that the bank had in mind, that inflation is primarily caused through an economy that is overheating, and so when this demand fell even lower, inflation becomes lower?
So I think it's important, and maybe it's good to take it on at the start of this conversation.
Yeah.
I think the way to think about it is there's two parts to inflation. One is the anchor. What is the anchor of the system? And then around that anchor, inflation will fluctuate with either demand or supply shocks. So indeed, in the first year of the pandemic, it's probably fair to say demand was very low. People could not leave their houses. There was a big pullback. Of course, there were supply effects as well. But let's say in 2020, the big effect was low demand. Okay, in 2021, what did we have? So at the very end of 2020, the very good news arrived that the vaccines had been discovered.
Yeah.
And in the course of 2021, we had this kind of waves of recovery in the global economy, but also waves around the world at different times of new lockdown periods, because with new variants, we all remember this period. So in 2021, what we had was a partial recovery in demand, but supply being constrained, especially factories around the world having shutdowns and so on.
Mm-hmm.
So the initial rise in inflation, I think in 2021, I think it was commonly referred to at the time, and I think it still remains accurate. It reflected bottlenecks. There was a recovery in demand in the global economy, but the ability to supply goods was limited. And in that mismatch, prices went up.
And a counter that was often heard at the time was, because I think at that time there had already been a lot of stimulus, because like you said, policymakers were afraid of deflation, right? So wasn't there also a narrative at the time like, hey, look, the money supply exploded. Why do we look back at this and think, hey, actually it was the supply bottlenecks that were the biggest factor and not this stimulus? Because I think everybody can at least agree like that all of this played some role, but we're talking about what's really important.
Yeah, no, I think, of course, that this is a natural question to raise, given the fact that various indicators, for example, the money supply did go up. But what I would say is, of course, it varies around the world. But from a European perspective, I think it probably a better description of both fiscal policy and monetary policy in 2020 and 2021 was stabilization. So it was not trying to stimulate the economy because indeed the supply capacity was limited. There's not much you could do. But there was definitely a desire to make sure that incomes were stable. So even though many firms were only working on a partial basis, I think it would have made the pandemic situation a lot worse if we had delivered, if you like, austere policies that would mean income levels dropped in 2021.
Yeah.
So I think crucially from a European perspective, we did not see overall spending in, for example, 2021 go above the pre-pandemic level. Spending was still low compared to the pre-pandemic level.
Yeah, okay.
Right. And so I think this is fundamental.
Yeah.
It is essentially the increase in the money supply. A lot of that was firms who needed to take on short-term loans to pay their wage bill, for example. So it wasn't stimulus in terms of expanding the economy, it was keeping the doors open, if you like, the factory doors open.
So a lot of the money supply increase, because I think a popular narrative is like if the money supply increases, there's money printing by the government and central banks. So that's sort of the simplified view there. But are you saying that a lot of that actually came from private firms taking out loans with private banks, of course enabled by very low interest rates? And that increased the money supply.
Right, so if you look at essentially the overall creation of money, indeed there was a lot of credit provided by banks to corporates. We also created money directly. For example, we did have a big bond purchasing program.
Yeah.
So at that time, I think governments ran very large deficits. I think if we wanted to make sure that households, workers, firms maintained, if you like, income during this period, then the government had to run large deficits. And if you like, in order to make sure that we could also maintain stable financing conditions, there was a big special bond purchasing program at that time. So there was money being created directly by the central bank, as well as the indirect money, if you like, the commercial money created by banks. But critically, for the question you raise, the overall level of spending remained well below the pre-pandemic level. Yeah. And, I think it's very important to recognize, maybe behind everything it was 100 years since the last global pandemic. I think the economic world as well as the public health world, many worlds, studied very hard the nature of a pandemic, what it was needed in terms of policy. So maybe to kind of summarize on this, I think the policies in 2020 and 2021, which were extraordinary, were basically just matching the extraordinary challenge of the pandemic. So coming back to the inflation issue, I do think maybe one fairly basic way to think about it is in 2021, if it had been a money-created inflation, that classic story basically means people would go out, they had too much money, and therefore they would say, okay, let's spend. And then you would see the demand for everything go up, prices for everything go up. That's not what happened. What happened was basically a large increase in the price of goods, because even sitting at home, you could still order a new exercise bike or other things, and also an increase in the price of energy. The services sector was still very restricted.
Yeah.
So I would say it looked more like a supply shock in the sense of the prices of those goods where supply was scarce rose quickly. And the reason why we say it's a bottleneck is at that time, which I of course remember very vividly, you could look forward and say, okay, this bottleneck is not going to last forever. The vaccines are now being rolled out. As the vaccines get rolled out, the economy will normalize, and all of these factories that are currently shut down will reopen, and the ability of the economy to supply what is demanded will improve. So in other words, a bottleneck by its nature means there's a spike in prices, but then later on that reverses. And in fact, we have seen since late 22 onwards a reversal in a lot of those price pressures.
Yeah, okay, because that's I think part of the criticism also sometimes, like, okay, prices have gone up, but they never go down. But actually for a lot of these goods, like bikes indeed, I remember during the pandemic, they have come back down, right? Like they're...
Well, I mean, I think to some extent, you might see it in some goods. I'm not going to exaggerate the amount they've come back down, because then in the full dynamic of the economy, there's a catch-up of other costs, including wages and so on. But what has come down is energy prices. So from the peak, which was October 22, in summer 23, the energy prices in Europe fell by 14%. So again, not just zero inflation, deflation of 14% over a number of months. And that has played a big role in what's happened.
Yeah.
So let me mention, because we've talked about the pandemic there.
Yeah. And there, before you go on, because I think you're moving to the next subject, like if I can sort of summarize there, if I understand it from you correctly, is that you work on a sort of data-based, like evidence-based approach, like looking back, hey, okay, maybe there was some evidence, like the money supply increasing that initially pointed in sort of, or for some points in a money printing kind of story, but that then we would not have seen, or then we would have seen that spending would have gone out of control. We have not seen that. And then we would have seen a general increase in prices rather than just focused on a few sectors. And so based on all of this evidence, we can maybe conclude like the most reasonable story about inflation, looking back before the Ukraine invasion at least, were the supply bottlenecks.
Right, and again, you come to the same point I was about to make, which is essentially there were two different, if you like, inflation episodes, but they came one right after another.
Yeah.
So in 2021, I think the bottleneck description gets you most of the way. In 2022, we essentially had the Russian unjustified invasion of Ukraine in late February, but of course there were kind of debates about whether it would happen from late 21 onwards with the kind of positioning of troops and so on.
Yeah.
And I think it's very mechanical. What happened is essentially mostly in the gas market. There was this gigantic shock to the gas market where the Russian supply was now not available, and that had a very large impact. But let me emphasize again, at more or less in the exact same weeks and months, we had the final reopening of the European economy. Because if you remember, in late 21, December 21 through maybe February 22, there was a kind of renewed lockdown of many parts of Europe because of the Omicron variant.
Yeah.
And so essentially in February, March 22, at the same time we had the Russian invasion of Ukraine, which was very destabilizing for the energy system. But we also had the reopening of the European economy. And for many people, the first time they could really do, for example, tourism or business travel was spring, summer 22. So in the exact same months, we had this very negative supply shock from the war. But we also had, if you like, the good news of the reopening of, for example, the tourist sector in Europe. And so it is really in parallel. We had the big energy shock, but there's also a contribution from this pandemic reopening, this is the phrase we use, because tourism, people very quickly want to travel, go out to restaurants and so on. But of course that sector, supply capacity had gone down. Many people left because there was no work for them for 2 years, had left this sector. Many airlines had cut back on their schedule and so on. So there was, if you like, a perfect storm of inflation in spring, summer 22.
Yeah. And then, okay, so that is also a supply side issue largely.
Right.
And then, then why did the ECB raise interest rates? Because that is only affecting demand, right?
So this is, I think where again, you have to learn the lessons of history. And for example, many people look back to the 1970s, which is what happens when you have these really big, extraordinary, and as you said at the start, very much from the point of view of many people below a certain age, unprecedented increase in inflation. Even if the origin is supply, it's very natural that essentially two factors would then create a next stage, a second stage of this process. One is that firms were seeing their costs increase. So across the economy, firms use a lot of energy, for example, and they use all sorts of other inputs which have gone up in price. So even if these firms were not seeing an increase in demand, in order to avoid making losses and to survive, they had to raise prices.
Yeah.
On top of that, workers, workers often how wages are set is quite slow. So initially, that very large increase in inflation was not matched by an increase in wages. And so people suffered a very large decline in their living standard. But over time, it could be expected that wages would have to rise to compensate for that increase in prices.
Yeah.
So monetary policy comes in to make sure that second stage, if you like, does take place, but it takes place in a way that people understand will come to an end. So what we say is there'll be a timely return of inflation to 2%. So not that inflation would go from 10.6% in October 22 to 2% overnight. It was inescapable. There would be, if you like, a second stage of wage and price adjustment, but to make sure that did not become, if you like, the new norm.
Okay, I see.
And then what happened in the 1970s is more or less it became the new norm. People got used to prices rising 5, 7, 10% a year. So we had to make sure through raising interest rates that process would come back fairly quickly over a couple of years back to the 2% target.
So then the central bank is going to the sort of final step in thinking about inflation. We've talked about supply and demand before, but now we're talking about expectations, where the idea I think is that they can be self-fulfilling in a way that if people expect inflation, they'll raise prices, and then other people will raise prices as well, and that can happen, almost independently from supply and demand. That's the idea, right?
So usually it needs a trigger, and so the shocks were the trigger, and that's why I said at the start, there's really two factors in to think about inflation. One is the anchor, and then around that anchor, you can have these supply and demand shocks.
And the anchor, so that's the anchor for expectations,
Right.
which hopefully is the 2% target that the central bank says, I think, but also often just what happens in history.
Yeah, so I think this matters in both directions. So before the pandemic, we had concerns that inflation expectations were drifting down. They were becoming more like 1.5 or 1, not 2. And after the pandemic, there was a very natural reason, because historically this has happened before, that if people see inflation way above 2%, they can question, why should I believe inflation is going to be 2% 2 years from now, unless I see the central bank delivering policies that are going to make sure it happens. And so the central bank, through its monetary policy, is basically providing that anchor. And so what is the alternative? The alternative to an anchor is what we call de-anchoring, that the anchor loses a grip and then it can get reset. It could get reset. We've had hyperinflations around the world. We've had other countries settle down at inflation rates of 10 or 15 or 6 or 8. Pick any number you like. But for us, we were convinced that it was very important to make sure that the target of 2% was maintained.
Yeah. So to avoid sort of the Turkey scenario.
Well, that's one example, which of course, inflation in Turkey, has been quite high, and as you say, extremely volatile, and that tends to go together. High average inflation and high volatility tends to go together. So clearly, it's very important to make sure that inflation comes back to 2%. And again, if we fast forward a little bit, in our meeting last week, we kind of, if you like, reaffirmed our kind of projection for the future, which is essentially inflation's now in around 2.5%, that we will be back to 2% in the second half of next year. So there's another year where inflation's a little bit too high, but that's, if you like, the ongoing second stage, which again, as I said, it's inescapable to have that second stage, but we need to make sure it doesn't go on too long. And in that second stage of catch-up, where wages and prices are catching up, that it basically is a moderate process.
But I do think that's a very interesting answer, actually, because I don't think it's talked about enough often, that you're saying, hey, we know that maybe it's been a little bit unfair that prices of goods, for example, and energy have shot up, but wages have not caught up, right? Or maybe if we go back a little bit to the pandemic supply bottlenecks where there was a big debate that profits exploded for a lot of companies. And so I think when a lot of central banks started raising interest rates, a counter narrative was, or sort of, maybe this is unfair because wages need to catch up, right? But actually, I thought that was interesting that you mentioned, like, we're aware of this, and this is why we didn't maybe raise interest rates like they did in the 1980s with Volcker shock in the Fed or something. Like maybe, if you didn't take that into account, you would have maybe hit it to 8% or something.
So I think what's important is what would have happened if like wages did not grow. Then I think we'd have a very severe recession, because with people having we've seen it, people have had a lot less income, which means lower consumption, means lower growth rate in the economy. So it's important that wages do not remain so far behind prices. So as I say, it's necessary and inescapable that wages do have to adjust. But there has to be, if you like, an orderly, gradual process. It doesn't make sense to have it instantaneously, but equally it doesn't make sense to go too slowly. And but the context, so whether it's employers or unions or individual workers, the context of how should this process work has to be anchored in the understanding that over time wages need to catch up, but equally it cannot be a situation where we get into a cycle where the wage increase is too high, prices have to be reset too high, then the next round of wages. So that's the famous wage price spiral, if you like.
Yeah.
We haven't seen this.
Yeah.
But again, it goes back to, I think, the context where throughout this whole period, there has been a high degree of confidence, whether in our surveys of households, of firms, our surveys of financial market participants and so on, that essentially some questioning about how quickly it would take place, but essentially there was a collective confidence that inflation would come back to 2% within a reasonable time period.
Yeah, and if we go to the rate hikes, how much do you think we can say that inflation has dropped because of these rate hikes? And how much do you think we can say it dropped because, of the factors you mentioned before that were temporary, or we might even say transitory if we want to be...
So I think there's different ways to think about that. So one, absolutely, I think it's important that interest rates went up to avoid, if you like, what I would call a pro-cyclical dynamic. If monetary policy had not seen an increase in rates, we could have seen the following situation. So remember, initially, not only was the interest rate low, our policy rate was negative. So what happens if you can borrow money at a very low rate and you are confident inflation is going to be high for an extended period? That's what we call a very negative real interest rate. So the inflation-adjusted interest rate is very low.
Yeah.
So you can imagine in that situation, if people believed that situation was going to last, there'd be a lot of incentives to borrow money, to spend quickly, because it sounds like money is you're being paid, if you like, to borrow in a real sense.
Yeah.
So this is often called the Taylor principle, that basically the interest rate has to rise more than the inflation rate.
Yeah.
In order to make sure that dynamic does not take hold.
Yeah.
Now, what is true is, and this is where the supply shocks come into it, it is in late 22, inflation was at 10.6. We did not raise interest rates by more than 10.6. So what was important was not the inflation rate right now, but what's expected over the next year or two. And that, again, because some of these shocks could be counted to either stop or even reverse, when you look ahead to the inflation rate that might be expected over the next year or two, it was always a lot lower than that. So what we have to do, if you look now, we have the policy rate, even after the cut we made in June at 3.75%. We have inflation 1 year from now, more or less at 2%.
Yeah.
So on that calculation, the interest rate is a lot higher than the expected inflation rate. And so you have to be in that situation, I think. And that's essentially what the first job of monetary policy is. Don't make the problem worse.
Yeah.
And then the second job is, because by raising the interest rate, you do lower demand in the economy and you accelerate the return. So it's not just the shocks expiring, if you like. You want to actually, I think, go a bit more quickly than that. And that's where the restrictive demand comes into play. And what we've seen in Europe in the last couple of years is the sectors where interest rates are very important, like construction, investment, and so on. They've been, have been very much affected by the high interest rates.
Right. So before we get to that, I just want to highlight sort of this, I think, still relatively subtle point that maybe people don't think about that much, which is indeed like real interest rates versus nominal interest rates, which is that if you had the nominal interest rate, which is what you communicate to the world, at, let's say, 0% or a little bit negative, and inflation is at 4%, then you effectively have a super negative or a really negative inflation rate interest rate.
Yeah.
Which is something, for example, that I think, again, in Turkey we saw where there was 80% inflation and then interest rates were, top of my head, I think in the high 20s or in the 30s or something. And then people were saying, but these are super high interest rates. Yeah, but if you correct for inflation, they're actually extremely low. So essentially, as a central bank, I could imagine that even if you are, as they would say, dovish, thinking that inflation will come down again, you have to follow it somewhat at some point, because otherwise you just have a really negative interest rate, which is not appropriate.
Yeah, so I think, as I say, this kind of distinction between the more dovish and more hawkish individuals is, I think, not the context of what we're talking about. This is, if you like, central banking 101. You do have to make sure in this situation that interest rates go up enough that you don't add to the problem by having, if you like, the kind of speculative incentives you would have with very negative real interest rates.
Yeah, and then you mentioned, interest rates went up and they have already had an effect in certain sectors, specifically like construction and maybe investments for firms
right,
as well.
So I think, again, when you look at the economy, you can think about what we call like interest rate sensitive sectors. So construction is one, because of course, if you think about a building that's going to last for 30 years, it's very natural that a lot of that building cost will be financed by debt. So by raising the interest rate, you make that more expensive, and therefore the demand goes down for construction. The same is true for investment in equipment or in building a new factory. The same is true as an individual in terms of, for example, renovating a house, a new kitchen, think about buying a car and so on. So there are those sectors where demand will respond quite a bit to the increase in interest rates.
And there's a criticism on there, and I wonder how you would respond to that, which is that because these are the sectors that are so sensitive, you are actually adding to the inflation problem in the sense that, for example, in housing, like a major part has been that there has not been enough housing construction. And then one of the first casualties is housing construction. And then same can be said for firms, right? Like we need all of this new investment now in green energy to get rid of the Russian gas and that part of the energy solution. And now we're raising interest rates. Like how would you respond to that?
Yeah, so I think you cannot, if you like, wish the problem away. So we had high inflation. The recipe, which I think is inescapable, meant we had to raise interest rates. But what is fundamentally central to everything is that it succeeds. And it succeeds if inflation, as we think it's happening, comes down relatively quickly to our 2% target. Because what does that mean? It means over time we can walk back from the high level of interest rates. And in turn, as we walk back from the high level of interest rates, that will allow these sectors to resume. It will allow construction to resume, green investment to resume. But let me just, in a side commentary, say, of course, on the fiscal side, the Next Generation EU and other programs have tried to protect green investment to a significant extent.
Yeah.
So I'm very comfortable with the kind of ranking here, which is if we'd kept interest rates low, I'm pretty sure inflation would not come down, and in fact we could have a longer term problem. And that's when you come to the Paul Volcker scenario. So Paul Volcker came in at the end of the 1970s when inflation in the US had not come down, and then you have to do something very painful, which is a really big increase in real interest rates, most likely causing a very big recession and a big destruction in investment. So if you like, to avoid that scenario, we had to be, I think, proactive. We certainly did not react immediately when inflation started to rise. But once we saw a few months later that essentially this is something we had to do. Then we were decisive. And this is essentially for those who are concerned about, as you say, the housing shortages we do have in Europe,
Yeah.
or the shortfall in green investment. I think everyone has to be a lot happier in a world where inflation comes back to normal, therefore eventually allowing interest rates to normalise, than if we had a kind of decade-long or longer problem with high inflation, which would lead to just higher and higher interest rates to kill it. So this kind of preemptive approach, if you like, was, I think, more fundamental, because the alternative is not a kind of indefinite investment boom. I think the alternative would have been inflation remaining too high for too long.
So could we say, okay, like we recognize that maybe some sectors are, you know, an unfortunate victim of an interest rate increase, but I think economists always talk about how monetary policy, interest rate setting is a blunt tool. But in this case, it was still necessary to keep expectations in check. And then I hear somewhere that, you know, you say, but actually if we want to target certain sectors, then fiscal policy, that is government spending or, you know, promoting investments, can actually do that, like independent of our interest rates, which are just needed to control inflation. Is that fair?
So let me try to kind of break that down into segments. So in general, fiscal policy is better suited to dealing with, if you like, sector-specific problems. Because as you say, there's only one interest rate policy. We cannot tailor it to individual sectors. It's also, I think, fairly commonplace is, by and large, fiscal policy is a slow-moving beast. It's very hard to be very kind of responsive with fiscal policy.
Yeah.
Now, there are exceptions in this time period. So this is an unusual time period. So in relation to the pandemic, we already talked about there's a lot of fiscal transfers had to be made to households, to firms, to keep them going. Then I also mentioned Next Generation EU, where essentially the as part of the overall kind of recovery in Europe, there was a multi-year program which runs out to 2026 to stimulate especially investment in the green transition, in digitalization across Europe. You know, more important for some countries than for others. That is still ongoing. So that has been an important protector of investment.
Yeah.
What I would say also, of course, now with the Russian invasion of Ukraine, there's also been, I think, an imperative for many governments to raise their defense spending.
Yeah.
So,
Germany has already raised it by a lot, right?
Right.
Above 2%.
So there has been in this period, and maybe fine with the energy. So one fiscal challenge was the pandemic. Then you have the defense challenge. But then with the really sharp increase in energy prices in 2022, you know, I think it was very important for governments to support households to deal with that. And there was a lot of also extra fiscal spending to, if you like, provide some subsidies in different ways across Europe. So there has been a lot of fiscal activity in this time period. And of course, what's going to be very important as we see the recovery continue, and let me say, from our point of view, the European economy did not grow very much last year. Yeah. But we do see now, for the rest of this year and next year and into 2026, a recovery in the European economy, which, if you like, will allow the private sector to, you know, provide more spending support for the European economy. And it's important for governments, having done quite a lot, if you like, to normalise their fiscal positions. And this transition, this handover between public and private, of course, you know, it's very natural from a macroeconomic point of view, but of course, politically challenging to deliver that.
So do I hear in that a little bit like that now is the time, and I think we're going to transition to the future of inflation and interest rates now, that, as you mentioned, governments have spent way more than they usually did for very good crisis after crisis after crisis. Are you saying that now, okay, to get inflation sort of to stick around the target, we need governments to start spending a little bit less and for the private sector to pick up again?
So I wouldn't centre it on inflation, but more generally, I think if you want fiscal policy to respond, as you say, to these crises, when you're out of crisis mode, fiscal policy has to step back. Now, I would say already this year, it's very important, and we are seeing it, that those energy subsidies that they brought in 2022, by and large, more quickly in some countries than others, are being rolled back. Yeah. Many pandemic supports have been rolled back. So there has been a lot of, if you like, expiration of extraordinary measures. And what we do have is essentially the legacy is debt levels of governments in Europe did come up in recent years. And this is why the European fiscal framework, it's not kind of some big 1 year only adjustment. It's just saying essentially over the next, number of years, stretching out, I anticipate in many countries, even over the next 7 years and indeed longer, we'll have to be in a mode of, if you like, normalization, saying we have to bring the deficits down to a level that will make sure our debt levels will be sustainable into the future. So it is a gear shift, but it's not kind of, if you like, driven by some immediate crisis. It's just driven by the basic principle that, after extraordinary measures, you have to normalize.
But if you say for debt levels to be sustainable, do you think that they have to start falling again a little bit or stay roughly at this level?
Well, I mean, here's where I think rather than have a kind of unique message, because debt levels are very different across the European countries, this is where it's going to be, if you like, an interaction between each member state and the European Commission. And that's the right forum for thinking country by country. So let me leave it saying, from my perspective sitting here at the ECB, the overall pattern is clear, but the exact recipe for each country needs to be, I think, decided first and foremost at the national level, but then in dialogue with the European Commission.
And where do you see, because I do think fiscal policy and all of these crises are going to play a big role in sort of the dynamic between interest rates and inflation for the upcoming years or decades maybe. How do you see this? Like, I think there is this general view that we're coming out of this low inflation, super low interest rate world. And as you mentioned at the start of this conversation, there was the expectation before the pandemic that we're stuck in this. But I've been sort of hearing more and more economists saying, actually now we believe that we're not going back to that world anymore. And maybe we're going to be in a world where interest rates, nominal interest rates, will be around 2-3% or something, and inflation will be around 2% rather than where it was 0% and negative nominal interest rates. Do you think that that's the world we're heading to? And if so, what are the main macro factors driving this?
So let me differentiate between three scenarios. One scenario is if inflation is too low, so below our target on an indefinite basis. That's what we had before the pandemic, and our monetary policy strategy would say, under those scenarios, you do have to have accommodative policies. So bringing interest rates down, maybe also doing quantitative easing and so on. So what is the probability of that scenario? And that's where I think there is a consensus. Right now, it's not the most likely outcome.
Okay, yeah.
And if you look back in that period, this is a period that came, I think, first and foremost after the global financial crisis, which really damaged, the European and global economies and led to this kind of low demand situation and low investment situation. So that is one scenario which I don't think is top of mind.
Which is huge, right? That's a big change in the profession.
Well, I mean, it's a big change in the world, which in terms of profession looks at the world and looks at that. So then the other two scenarios is essentially we're in a world where maybe there's no big extraordinary shock and we settle down into some kind of steady equilibrium. And then the third scenario is we're going to be hit by a wave of new shocks. And people have thought a lot about new shocks, which possibly will be creating more inflationary pressure than disinflationary pressure. So let me take that last scenario first. This does not necessarily mean, by the way, that these shocks are kind of going to lead us to having inflation above 2 indefinitely. But imagine some new shock comes along, inflation pops up to even 3%, let's say. Then, of course, we would raise interest rates to bring it back down. So that's a world where, on average, shocks are bringing us above target, which means on average we'd have to raise interest rates above their equilibrium level. Yeah. So that's
a higher interest rate world for a longer time.
But that goes back to, but that is the appropriate response if you see those shocks. Yeah. But then I think because of shocks by definition it's hard to know when or if they're going to happen. So the other debate is, where is the equilibrium? Where is that long run equilibrium if there's no shocks? And this is where...
So that's the final scenario.
Right. The scenario where essentially we settle down. Yeah. And it's what is the interest rate we need to keep inflation at 2? And essentially, it's still the case, a lot of the research, including here at the ECB, would say that interest rate remains relatively low. So you give a scenario where maybe the policy rate will be somewhere between 2 and 3. We published estimates in our economic bulletin earlier this year, where a lot of the estimates were essentially that the real interest rate would be around 0, which means a policy rate, when you add in 2% inflation, around 2. But there's definitely more weight, if you like, now on a little bit above 2 as well. So we publish external views, the survey of monetary analysts, which again your viewers can find on our website. And the most popular answer in that survey now is maybe 2.25, 2.25, maybe 2.5, maybe 2. So that zone of 2, 2.5, let's see what happens. Going much beyond that, I think you would have to say, okay, there's some reason why we're moving into a world either with more investment demand or less saving. And this goes back, it's very interesting, is will we see a very strong green transition? Will we see a surge of investment driven by the green transition? Will we see an investment surge driven, for example, by the opportunities of AI? So these things are possible, but this is where, going back to, we're very evidence-based. If we see this, then we would respond. But on the other hand, we also know the European population is aging. Yeah. And aging typically is involved with low investment and high savings, especially when there's maybe within that aging aggregate, increasing longevity. It's very good news to have increasing longevity, especially if those extra years have high quality of life attached to them. But essentially what that means is either people work longer or if they have to save more for retirement. Yeah, yeah. But anyway, I mean, I think there's a very interesting debate. But for your viewers, coming back to our role is not to essentially pre-commit to any particular vision of where this is going to be. The world will tell us. The world will tell us as the world evolves. Will we see high investment? Will we see lower savings? What will be the attitude to risk? So one big issue from the pandemic, the war, the heating of the economy is essentially the attitude of individuals and firms to this uncertainty. We live in a very uncertain world. And what does that mean for savings rates, for investment rates? And that's going to be one of the big questions for the coming years.
I think it's really interesting that, when you talk about these two scenarios, maybe this very high risk scenario or high inflation and high interest rate scenario where you're talking about shocks. Now, I would interpret that as geopolitical shocks, maybe like continued geopolitical shocks after the Ukraine war. Maybe you have something else in mind. But then the second scenario where interest rates are still higher than what they were before, inflation is typically higher, they go along with each other. And then you mentioned these three key trends where there's one like big investments or innovation, which is actually a really positive trend, but could mean higher inflation and thus higher interest rates. And then the second, aging, which is I think talked a lot about before the pandemic as the deflationary trend. But now I also see more and more people saying maybe, like Professor Charles Goodhart is one of them, saying maybe the aging thing caused deflation before people actually reach the age of retirement, but that may flip, where you have this huge demographic that is spending actually a lot because they're already retired. But okay, maybe that's a whole other discussion.
No, sure. I mean, it's a live debate about aging, so that's why I kind of then zoned in more specifically about longevity, where longevity, I think, definitely.
Because then you have to save much longer.
Right. So I think there's still a lot to think about with that, and of course you have to think about, if you like, the world aging, not just the European economy aging on that. But let me come back to and this is, I think, very important. You were saying, well, these various shocks or trends could be inflationary. At some level, I think that's not the way to think about it, in the sense of, yes, shocks. If something unexpected happens, then you could see a surge in prices or a collapse in prices as an immediate response. And I do think probably this consensus, in a more geopolitically fragmented world, we could see inflation becoming more volatile.
Right, okay.
That is true.
But maybe not inflationary, just more volatile.
That's one element. But the other element is, it's not so much that you might see, because if we do our job for the predictable part, if we can see something that it's not a shock, it's kind of an established trend, then essentially we would adjust interest rates in line with that.
Yeah.
So you might not see any inflation.
Yeah, but then you see higher interest rates.
Exactly, or lower depending on the nature of what you're looking at. So this is, if you like, for some of your readers or viewers who have studied the Phillips curve to some extent. This is, if you like, one of the kind of main puzzles in trying to look at the data. Central banks, we do try to anticipate where we can. And so you might see the ideal is a world where, if you don't have shocks, inflation is around 2. Mm-hmm. But the interest rate needed to deliver that 2% could move around. But then, of course, when you add in shocks, then you get the volatility, and then you get also this kind of cyclical response, which is what we've done now, which is essentially a number of years of high interest rates. But then if inflation stabilizes back to target, rates will come down. And that'll be an interest rate cycle, but if you like, around some longer run equilibrium trend.
All right. I think that is something to think about for a long time for people after watching this video. Thank you so much for talking to me, taking us through the whole thing, start to finish, and with a little bit of a preview of possibilities. And I think you also emphasized there something that I see with many central bankers, this emphasis that you do not have a crystal ball, you cannot look into the future, but you are looking at scenarios and you're acting and accordingly and changing the probabilities of these scenarios perhaps in your head based on the evidence that's slowly coming in.
And this is why we meet every 6 weeks, because the world can change. And that's why some people think about this on a kind of abstract level. Of course, we do that also. but we also know we can adjust our policy every few weeks.
Excellent. Thank you for this inside look into the mind of a central banker.
My pleasure.
So I hope that conversation gave you some valuable insights into how the ECB views the future and the past of inflation and interest rates. For me personally, there were 3 standout insights about the previous inflation spike that I had not considered before. The first is that Philip Lane argued that a lot of why the money supply increased so rapidly in Europe during COVID came from firms taking out additional loans with private banks to continue paying employees throughout the lockdown. This, together with higher interest rates, could explain why the money supply in a country like France is now again on a pre-COVID trend. And second, a subtle second insight that I thought was interesting is that Lane told us that the ECB raised rates by less than it could have to give wages a chance to catch up to these otherwise increased prices. Thirdly, I thought that it was really interesting that Mr. Lane acknowledged that higher interest rates could increase inflation in the future by lowering investment now, for example, by slowing down housing construction or investment in new energy sources. However, there he did make a point that these unwanted sector-specific effects can be offset by increased government spending or incentives in these sectors. Finally, when it comes to the future, it really stuck out to me that the ECB thinks in terms of 3 scenarios. The first scenario is a return to the pre-pandemic trend of ultra-low inflation and therefore ultra-low interest rates. It considers this scenario unlikely because of big trends like an aging society in which retirees spend more or a big investment surge driven by the energy transition or AI. These trends could push us into the second scenario, which is a fairly stable scenario where both inflation and interest rates settle around 2 to 3%, meaning that the real interest rate will be around 0%. Finally, the third scenario also has higher inflation and interest rates, just like the second, but in this scenario we will also see more of these volatile inflation shocks, which will then mean that the ECB will need to respond with again higher interest rates from time to time. A primary reason that we will find ourselves in this scenario could be further geopolitical fragmentation. Food for thought. But before we end the video, I just want to say that I tried to keep this conversation as accessible as I could without, hopefully, losing too much depth. But this is quite a technical subject, so if anything is unclear, feel free to ask me questions in the comments. I will try to answer as many of them as I can. And if you like this type of content, bringing in-depth economics to a broader audience, then please consider supporting my work via Patreon or by becoming a member. Money Macro is still largely a one-man show, but to create more content, I really need to outsource some more stuff, and to pay for this, I really need a steady base of income. Specifically, with 100 or so more patrons or members, we can start looking for an economist or journalist to help me to make more content for you. So yeah, if you want more content, your help really helps. Please support the channel by becoming a long-term patron at patreon.com/moneymacro or member by clicking the join button below.